Hello, I'm Katrina M. Craft, and you've just tuned into the Craft More Cash podcast, where finance meets innovation and strategy becomes reality. With over 2 decades navigating the twists and turns of accounting, tax, and business strategy, I've had the incredible opportunity to work with startups and Fortune 500 companies alike, crafting pathways for businesses to grow and thrive. I've tailored my expertise to serve the unique needs of industries ranging from real estate to creators to marketing and beyond. I'm on a mission to equip individuals with the financial savvy they need to succeed. Through my Wealth Intelligence course, I'm all about breaking down complex concepts into actionable strategies for business owners. Welcome to Craft More Cash. Let's make wealth building simple, fun, and effective. Ready to transform your financial journey?
Hello, Katrina M. Craft, business profitability coach and tax strategist. Today I want to talk about how do you pay yourself as a business owner. When you're starting off, a lot of times you may have a personal account and you are spending money for business activity. Don't do that. Even if you're just starting, open up a business account. You can open up a business account as a sole proprietorship and spend money for business activities only out of your business account. That's very important that you don't commingle, because oftentimes you may miss expenses if you pay for them personally. You miss deducting those. And if you're ever audited, the IRS will be able to ask for your personal account, because that's where all of your business transactions are happening, or some of your business transactions are happening. And you do not want to just be able to allow the IRS to open your books for an audit and see all of your personal activity. It's just something that I would try to avoid at all costs. So make sure that you are having a separate account. If there are times where your business does not have the cash flow it needs to pay for expenses, what you should do is not use your personal account. Your business can get a loan from you personally. So what would happen is you personally could loan the business the money. So transfer money from your account to the business account, or write a check from your account to the business account. You would have a loan, and it would have all the terms. So you could have an open line of credit, which that would be something that's not a payment term, not a payment fixed amount. And you could have an open line of credit, which will allow you to borrow from yourself and pay it as an open line of credit. So that's one way to do it. Make sure when you're loaning your company money, you have a document that shows you're loaning the money. It shows that it's a line of credit, open line of credit. Maybe it'll show that it's $50,000 or whatever amount that you're loaning, and the interest rate. And that is how you would record it, to make sure that you're documenting that you've loaned the company money. You can also invest in your company. So if you do not want the money back as a payment of a loan, you can invest in the company. So that's another way to fund your expenses of your business if there's not cash flow in your business at any time. Okay, so do not use your personal account because there's no money in your business. You should first transfer the money either as a loan or investment to your business account, and then pay their expense. There's been some questions I've had on how do you pay yourself as a business owner. Well, it really just depends on your structure. If you're a sole proprietorship, you can take a draw. So that means you just go into your business bank account and you withdraw funds. That's called a draw. If you're an S Corp, you should have a salary. So you should pay yourself a reasonable compensation. That's very important, that word reasonable compensation. If the IRS determines that you have not paid yourself reasonable compensation, they could come back to you and say it's not enough. They would assess penalties on you, and as well make you pay a reasonable wage and pay the taxes that you did not pay by paying yourself too little. That's very important. That is a line item. They ask how much are the officers paid, what's their compensation. Because that is a line on the tax return, you need to believe that that's an item the IRS will look for. So as an S Corp, make sure you're paying yourself a reasonable salary. If you are a partnership and you're a partner in your partnership, you have guaranteed payments. So you're not going to pay yourself a salary through W-2. It's called a guaranteed payment. That's the best way to do it. There are circumstances where you can pay yourself a W-2, but you have to be very careful and make sure the guidelines are met to pay yourself a W-2. If you have any questions about that, as a business profitability coach, those are some of the guidelines and the coaching that I provide to my clients to allow them to know, how do you pay yourself? How do you manage cash flow? How do you do a loan for your business? If you are a C Corp, you also have a salary. So as a C Corp, it has its own tax return and you pay a salary to yourself. You could also get issued a dividend. So if you withdraw money from the company, you would have a dividend. And that's why sometimes it's said that a C Corp has double taxation, because if you do a dividend, you're taxed, and then you're also taxed on the net profit of the business. Another area that I want to make sure that you understand on how the taxes are flowing for your sole prop, that goes on the Schedule C on your individual tax return. If you're a partnership return is required, and then you get a K-1 that reports all of the financial transactions that you need to report on your tax return related to income, depreciation, your guaranteed payments. All of that is issued to you on a K-1. That K-1 then goes on your individual tax return. On a S Corp, you get a K-1 as well. That gets reported on your individual tax return. So the sole proprietorship, the partnership, and the S Corp, they are taxed at your individual tax rates. With a C Corp, it has its own tax return that does not flow to your individual tax return. And currently, it's a flat tax rate of 21%. So it's very important to understand how you're taxed and how you pay yourself. Now, on an S Corp, if you have profits in your business at the end of the year, that also flows to your tax return. Even if you do not draw that money out or take that money out, you will still be taxed on that profit. So make sure you understand that, and that is on the K-1. Also, on the partnership, that profit is also on the K-1, so it allows the tax preparer to know what needs to be taxed on your individual tax return coming from the partnership return. I received a question regarding, can I deduct Dutch treat business meals? The answer is yes. You need to make sure, if you are having a business meal and you're paying for your portion and the other people are paying for theirs, that you keep record of the meal, the amount, the location of the meal, the business purpose. So if it's a client, an associate, an employee, you need to make sure you keep track of that. What you discussed, or the purpose. So it may be business relationship, building a relationship, going over the digital plan, going over new ideas. Make sure that you list that. And in the notes, if you spent $100, $150, you're going to put that and say, my portion of the meal. But you absolutely can deduct your portion of a Dutch treat meal. The other person would deduct their business portion of that meal. You just need to make sure that your records are clean. That's with any meal. You need to record those items. Again, receipts showing your purchases, your food and your drinks consumed, proof of payment. So if you use your credit card, a statement of accounts or check, or if you use cash, you need to make sure you have that receipt. And if you have names of people who you had the meal with, as well as a record of the reason. But please know, you do not have to pay 100% for the meal to get the deduction. Also, in 2023, it reverted back to meals at restaurants or only 50% deductible. In 2021 and 2022, during COVID, the IRS, the government, wanted to incentivize business owners to visit restaurants because the restaurants were suffering because a lot of them did not have full service, had limited availability of occupancy. And 2021, 2022, 100% deduction was allowed for business meals if you got them from a restaurant, either consumed at the restaurant or to go. So if you have not prepared your tax returns for 2021 and 2022, it's not too late. But 2023, it reverted back to 50% deductible. But you must keep track of those items, as I indicated, to make sure you get that deduction, and you can do a Dutch treat. I'd love to help you. If you are a coach, if you are a consultant, if you're a digital creator, and if you're a real estate investor, I'd love to help you craft more cash. Please look below, sign up for my coaching, and sign up to continue to get great information through our podcast. Make sure you stay tuned for more information on crafting more cash. Thank you.